Hey, good morning, everyone. Welcome to March. Welcome to Monday. Welcome to Monday Minutes. Crazy week last week for many. Obviously, the buzz in the rate market, not totally unprecedented in terms of historical moves. We have seen some of these, call it what you want, tantrums, mini tantrums. Nonetheless, we're coming off extreme low rate levels in 2020. We go back to March of 2020, the Fed's framework change in August of 2020. There's really something in this move for everyone. Inflation expectations along the way, the expectations of higher inflation, certainly a part of the story, although we don't think that was the story last week. A growth story, no question. The rollout of two vaccines and now Johnson & Johnson last week on top of that approval by the FDA to continue to roll that. So a growth story. What's kicked in as of late, and we saw this with GameStop on the equity side, ton of cash sloshing around the financial system. Positions certainly come into play. Duration extension, index extension, and fixed income in general as rates move higher. Certainly the cheapening of mortgages, some convexity hedging, position liquidation on top of that, and volatility, which has increased as well. So we've seen this move in real yields as of late. So what's the issue here? The direction in rates in general is right. I mean, the economy is improving. We should expect to see a steeper curve, and we should expect to see higher rates. But in general, it's the magnitude of the move. It's how rates are moving, not why rates are moving. Rates are presumably moving for the right reason. I mean, the Fed said that last week, a testimony to economic strength. The market didn't really like it because the market wants to feel that the Fed has its back. But in general, it's how the rate market is moving at this point. So we've had a market that's become orderly to disorderly, which is a concern. We had a very sloppy 7-year auction. We had a mini flash crash, which took 10-year notes out to 160, 10 basis points in a nanosecond. Global central banks losing control of their yield curve control. We've seen the RBA very aggressive to try and bring that back a little bit. So, and broader, financial conditions, how this is going to potentially spill over to financial conditions going forward. So the Fed is clearly watching right now, and they've got challenges on two ends of the yield curve. On the short end, we've got a ton of cash, bank reserves, which are growing as the TGA comes down, presumably going forward in the next couple of months. And at the same time, we have less collateral, so more cash chasing fewer assets, so buffering up against that zero lower bound. They do have tools there, interest on excess reserve and reverse repo. And then the SLR, the supplemental leverage ratio, which the Fed in April of last year extended an exemption for the bigger banks with regard to how they treat treasuries and reserves relative to capital. The chairman was questioned on this last week. He said the Fed is close to making a decision. So that has dynamics around whether they include reserves, whether they include treasuries, whether they extend it at all. And then in conjunction with that, Fed probabilities moving around. Last week, we saw the move in the treasury market shift from the long end selling off to the short end, the belly of the curve, cheapening, which has actually come back this morning a little bit on the curve. But we saw Fed probabilities move against the grain of what the Fed has said their projections are for the funds rate. So we do expect the Fed to offer something there. Then the long end, the messaging on the long end. We're going to see inflation from the Fed, but we think it's going to be transient. The market's worried. We think the economy is going to be doing great. Rates are moving higher for the right reason. We're not going to taper. So there's a little bit of a mixed message there in terms of substantial moving forward, what would shift asset purchases. And then in conjunction with that, what would that mean for the actual funds rate? So the market is challenging the Fed, somewhat confused. Volatility is not necessarily a bad thing here. The Fed has said this is outcome-based forward guidance, so it's dependent on the economy, not timeline. So we will look to see what the Fed offers this week. If anything, we get a ton of Fed speak this week, with culminating with Powell on Thursday. In conjunction with that, a lot of data. We'll get the Beige Book, we get ISM, we'll get ADP, we will get another claims number, and certainly the employment number on Friday. Wishing everyone a fantastic week. It's good to see everyone. We'll see you soon. I'm Greg Faranello, head of U.S. rates for Amerivet Securities.